What's going on, guys? Welcome back to the channel. Today we are going to be going through a stock called TGNA Inc., ticker symbol TGNA, and I just want to take a look at this stock because I think it's really undervalued, and yeah, let's just take a look at it, right? So, first of all, this company does a lot of things. It's kind of like a media company, which kind of just helps you with your projects. I don't really understand it, but from what I do, the moat isn't really great with this company. The moat is basically um, uh, the thing that prevents another company from getting into the same business. Like, for example, if you own a plane company, like you make planes, right? Um, if I wanted to make planes today and start today, I couldn't because I need like capital to build factories and everything. But Tegna is a media company, so not a big moat there. But anyways, so that's definitely something that we're gonna have to consider in our analysis. But anyways, let's now go to the charts. And first of all, guys, I'm not gonna be digging into the 10Ks. If you want to be doing that, you can just go into the investor relations and then go into like the 10Ks right here. However, I will not be doing that right now. I will be just going over the financials and the valuation. So, first of all, this company has been here for a long time. It has been founded in 1906, so it's not some kind of dumb company that just came out of the blue. And it's probably just gonna disappear out of the blue. Also, it has been here for a long time, so it's pretty stable, and the market cap is pretty big. Also, it's like 3 billion USD. So it's a pretty decently big company. Now, this is the profit margin chart. This chart shows the growth of the company for the past 10 years and the next 5 years. These are just estimates of analysts. They might be completely wrong, but they're just orientational. Right. So you can see that Tegna's profit margin is actually really good. They've been holding it above the 10% mark for their entire existence, and it's forecasted to go up in the next couple of years. So we like to see that. It's a little bit shaky, like especially the earnings, but it is getting there. So it looks good. Now for the free cash flow, it's basically the same thing. Minimal growth because it's kind of just a lot shaky, but you can see that in the last year they've actually had some very good numbers, and their free cash flow margins are very good also. Now, I'll skip the P chart and I'll go to the enterprise value to earnings chart. Guys, the enterprise value to earnings chart is the enterprise value, which is the market capitalization, aka the cost of the company, plus the debt to the earnings. So this means if you bought the company and basically paid all of the debt and took all of the cash, that would be the enterprise value of the company. And then that's compared to the earnings. So you can see that that's 11 in the last year for Tegna. And same thing with the enterprise value to free cash flow. Now, why I like the enterprise value to earnings and enterprise value to free cash flow over the standard price to free cash flow is because it supports companies with a great balance sheet. So, for example, if a company has no debt, the enterprise value to earnings will be the same as the price to earnings. However, if a company has a lot of debt, the enterprise value to earnings will be a lot higher. And if they have extra cash, it will be lower than the price to earnings. So, a little bit of a complicated ratio there, but it's fine. So you can see that it's actually really low in the last years. And then book value. So let's talk about book value. So the book value is actually really great. It has fallen, however, it's back, and it's really high compared to the market cap. However, there is this really important metric, the percentage of current assets. Now, guys, book value is assets minus liabilities, by the way. And percentage of current assets is the percentage of assets that are current. I know it sounds kind of dumb, but um, basically, this metric shows us if the company only has like buildings and cars, which can't really be used to pay down debt, right? Or it has a lot of cash, because cash is a lot better than buildings and cars, right? Because you can use it to grow your business, pay out dividends, buy back shares, or other great stuff for the investors. Now, let's actually go to the health now, and this is where it starts to turn around a bit. And that's because the debt for TGNA is really huge. However, if we compare that to the current price to free if we compare the current debt to the current free cash flow, the debt would be payable in like 3 years with the cash as well. So not that bad. However, it's still really high, and this is something that we're going to have to consider in our analysis. So you can also see that they have been paying it down and then got, paid it down, got some more, paid it down. But anyways, so now the shares outstanding chart. Now, this chart is not great. However, it's not terrible because over the last 10 years, the shares didn't go up, so it's fine in my books. And then the assets and liabilities chart, you can see that the gap between assets and liabilities has gotten a lot larger, which means bigger book value. So that's great. However, the assets are declining. Not amazing, but it's okay. Now, we're not going to check the division of assets, but it's just basically how the assets are divided. So if you want to look through that, you can. Link in description for the platform. And then now let's go to the ratios, right? And this is the return on equity, return on assets, and return on invested capital. So the return on equity is actually pretty decent, but it's not the best. But why this doesn't matter so much is because the return on invested capital is so huge, and also considering how much how many assets they have, the return on assets is actually really great, like 8% in the last year or 9% in the last year. That's actually amazing for how many assets they have. And the RYC is also great. So I love this chart. And now they do pay a small dividend yield. However, it's only 1.8%. But on the other side, it's they only pay out 13.5% of their earnings. So I'm a fan. Now, they haven't really done any investing or selling of investments, so I'm just not gonna look at this chart. Neither the acquisitions, because they haven't really done any acquisitions except in some of the years, so like 2019 and 2013, 2014, but not really much. And now we're going to go ahead and create a price that we want to buy this company at. Now, I already have the ratios in. And this calculator is basically a tool that helps you estimate the fair price to pay for this company. How it works is basically it takes the future free cash flows based on your assumptions and then discounts them at a discount rate. And then you get these numbers, right? And then you can compare it to the price and see if the company is overvalued or undervalued. So it's a great tool for seeing if it's time to buy or it's not. Even if you find a great company, great companies are not always great buying opportunities because they might not be at a great price. But anyway, I believe that TGNA is one of those companies, and you can see that I've only put in 468 for the growth, although it has been a lot higher historically. The 10 years actually 8, so I'm being a little conservative, but it's fine. And then profit margin, I went a lot lower here. So 13, 15, 17, and their 5-year, which is the lowest number, is just 16. So it's actually kind kind of closer to the high. However, we're trying to be conservative, and although we put in lower numbers for the growth, the profit margin, and the free cash flow margin, like a lot lower, we still got all of the numbers in the green, right? So this company is just such a great buy, in my opinion. And for PE, we didn't quite go that high either. Like, even if I go and change these to 6, 8, 10, so even lower, even more conservative, you can still see all of the numbers are very drastically in the green. Even if your discount rate was like a lot higher, you would still have all these numbers in the green by like 30%. So I just think that this is just a great buy. And I actually did buy this stock today, basically immediately after I've discovered that it's such a great company. However, you might disagree with me because of some of like the factors, like there's no moat, or maybe there's something I've missed. So if you think so, feel free to write down in the comment section, and I will look at all the comments and respond to you. Now, before we end this video, you can go ahead to this link and sign up for this platform for free. You can just do everything I do on here, right? You can follow along all of the videos, right? And I'll explain some of the stuff in greater detail for the beginners out there. And yeah, so if you want to see more of those kinds of videos, make sure to like and subscribe, of course, if it helped. And anyways, I hope you enjoyed, and I will see you next time.